If you are 65 or older, your bank is sending a report about your money to the Internal Revenue Service right now, and most retirees have no idea this is happening. Every single dollar of interest you earned last year was reported to the government before you even saw your tax form, and if you did not handle this correctly, you could be paying taxes on income you should never owe. This is not a scare tactic. This is the law, and the deadline to fix it is closer than you think. Stay with me because what I am about to share could save you thousands of dollars before this year's tax filing closes, and I am going to walk you through every single step before we finish. Now let me introduce myself properly so you understand why you should trust what I am about to say. I have spent the last 15 years helping American retirees navigate Social Security benefits, Medicare programs, tax deductions, and government assistance programs that most financial advisors never even mention. The information I share comes directly from official government sources, including the Social Security Administration, the Internal Revenue Service, and state-level tax agencies that administer senior relief programs. Everything I tell you today, I can back up with a phone number, a website, or a form number you can call and verify yourself. That is the standard I hold myself to, because your retirement cannot afford bad advice from someone trying to sell you something. In the next few minutes, I am going to walk you through 7 critical points that every American over 65 needs to understand about bank reporting rules, tax deductions, and the specific actions you must take before April 15th to legally reduce what you owe. By the end of this video, you will know exactly what your bank is reporting, who receives that information, what triggers an audit or underpayment penalty, and 3 concrete strategies you can implement this week to protect yourself. I will also share the new $6,000 senior bonus deduction that is available for tax years 2025 through 2028, but only if you claim it correctly. Let's begin with the most important question. What exactly is your bank sending to the IRS, and why should you care? Under federal law, every bank, credit union, and brokerage firm in the United States is required to issue a Form 1099-INT to any customer who earns $10 or more in interest during a calendar year. That information is sent simultaneously to the Internal Revenue Service through the same electronic reporting system the bank uses for every other tax document. The IRS receives a complete copy of your interest earnings, your dividend payments, and any other taxable income your financial institution processed on your behalf. And this happens automatically whether you request the information or not. The threshold is not $1,000 as many people believe. It is not $500. The reporting begins at just $10 of interest, which means practically every savings account, checking account with interest, certificate of deposit, and money market account owned by a retired American generates an automatic IRS report every January. Now, before you panic, let me explain why this matters and what the consequences actually are when the IRS receives your information. The most common problem I see with retirees is a mismatch between what your bank reported and what you reported on your tax return. If your bank told the IRS you earned $4,200 in interest, and your tax return only shows $3,800, the system will automatically generate a notice asking you to explain the difference. This notice arrives as a CP 2000 letter in an official IRS envelope, and it scares thousands of seniors every year into paying penalties they do not actually owe. The discrepancy usually happens because retirees forget to include small interest payments from accounts they closed mid-year, savings bonds that matured, or interest credited after the statement date, but before December 31st. Each of these oversights can trigger an automatic underreporting flag, and the penalties stack quickly when left unaddressed. If you are watching this and feeling that knot in your stomach because you remember receiving one of those IRS letters, stay with me. There is a solution, and it does not require hiring an expensive tax professional. If you noticed the issue before receiving the IRS notice, the answer is to file an amended return using Form 1040-X. This is the official Internal Revenue Service form for correcting mistakes on a previously filed return, and you can obtain it free of charge by visiting irs.gov/forms or by calling the number I will share with you shortly. If the IRS already contacted you about the discrepancy, respond directly to the CP-2000 notice using the response form enclosed in the letter, and include copies of every bank statement that supports your position. Do not ignore the letter, and do not call the IRS to argue verbally, because written documentation always produces better outcomes than verbal explanations that cannot be referenced later. Before I move to the next point, I want to remind you that if this content is helping you understand your money better, please take a moment to subscribe to this channel and tap the notification bell so you receive every future video the moment it goes live. Tax rules change every year, benefit amounts adjust annually, and new programs appear that could be worth thousands of dollars to your specific situation. Missing one update could cost you real money that you worked an entire lifetime to save. Click subscribe right now while you are thinking about it, because this single action protects your financial future for years to come. Let's now talk about the simple strategy most retirees never consider that legally eliminates bank reporting on a significant portion of their savings. The answer is moving non-essential cash into a Roth IRA or a Roth conversion account held at your same bank. Interest earned inside a Roth IRA grows completely tax-free and is never reported to the Internal Revenue Service as taxable income. This is not a loophole. This is the explicit structure of the program designed by Congress to encourage retirement savings. When your money sits in a regular savings account earning 4% interest, every dollar of that interest is reportable income when you file your taxes. When the same dollars sit inside a Roth IRA earning the same 4%, the interest compounds tax-free and never appears on Form 1099-INT, because the institution knows the account is tax-advantaged and follows a different reporting pathway. You can open a Roth IRA at any bank, brokerage, or investment firm, and the contribution limits for someone 65 or older allow up to $8,000 per year if you are single, or even more through catch-up contributions if you have years you did not contribute fully. The next point addresses the new senior bonus deduction that almost nobody is talking about despite being available right now. Beginning with tax year 2025 and continuing through tax year 2028, taxpayers age 65 and older can claim an additional $6,000 deduction above the standard deduction as part of a temporary 4-year relief provision designed to help seniors adjust to changing tax tables. This deduction is in addition to the regular additional standard deduction for age 65 or older, and it stacks on top of any other deductions you already claim. To receive this benefit, you simply check the appropriate box on your Form 1040 indicating your age, and the calculation happens automatically. If you use tax software to prepare your return, the program will ask for your date of birth during the personal information section, and the senior bonus deduction appears as a separate line item in the deduction section. If you file a paper return, the instructions on page 2 of Form 1040 explain exactly which line to use for the age-based additional deduction, and the senior bonus amount appears in a separate calculation table provided by the IRS each year in Publication 507. Now let me share something that could change your entire retirement tax strategy, and few financial advisors will ever mention to you because the fees they earn depend on keeping your money in taxable accounts. Many retirees hold substantial savings in traditional individual retirement accounts, thinking the tax deferral is the best strategy available. However, once you reach age 73, the IRS requires you to withdraw minimum amounts from traditional IRAs through the required minimum distribution program, and every dollar of those distributions is reported as taxable income on Form 1099-R. This creates a tax burden in your 70s and 80s that often exceeds the tax savings you enjoyed during your working years. The alternative strategy that works brilliantly for many seniors involves a partial Roth conversion of traditional IRA funds during the years between retirement and required minimum distribution age, converting small amounts each year to fill lower tax brackets without triggering the higher rates that apply when required minimum distributions begin. This is a sophisticated strategy, but the core concept is simple. Convert some money now while your tax rate is low, pay the taxes owed during the conversion year, and eliminate the tax obligation on those dollars for the rest of your life, including all future growth on the converted amount. Before we continue, please like this video and share it with someone over 65 in your family who needs to see this information. The reality is that millions of American seniors pay more tax than legally required every single year simply because they do not know about programs like the senior bonus deduction, the Roth conversion strategy I just described, or the Form 1099-INT reporting rules that trigger so many scary IRS notices. Sharing this video with one person could save them thousands of dollars, and your simple share helps more retirees than any grand gesture ever could. Comment below with the specific situation you face, because I read every comment and use your questions to shape future videos that address exactly what you need to know. Let's now discuss the third major reporting issue that catches retirees off guard and the specific action you can take this week to address it. Many seniors hold U.S. savings bonds purchased decades ago that have finally matured after 20 or 30 years of earning interest. The interest earned on these bonds is subject to federal income tax but not to state or local income tax, and the bank or institution holding the bond will issue a Form 1099-INT when the bond is redeemed. However, there is a special rule available to senior bondholders that you must request directly. If you use the proceeds from redeemed savings bonds to pay for qualified higher education expenses, you can exclude the interest from federal taxation entirely through the Education Savings Bond Program, documented in Internal Revenue Service Publication 550. For seniors without education expenses themselves, this exclusion can still apply if the bond proceeds are used for qualified education expenses of qualified family members, including children, grandchildren, nieces, or nephews. Talk to your tax preparer about whether this exclusion applies to your specific situation, because millions of dollars in tax-free savings remain unavailable simply because people do not ask. The fourth action you should take immediately involves verifying that your bank has your correct Social Security number and your correct legal name on file for tax reporting purposes. Banks report interest income using the Social Security number listed on the account, and if your bank's records contain an old number, a typo, or a married name you no longer use legally, the IRS will receive information that does not match their records for you. This automatic mismatch is one of the leading causes of those scary CP 2000 notices I mentioned earlier, and the fix is much simpler than responding to an IRS letter. Visit your bank branch in person or call the customer service number on your statement, request a review of your account information specifically for tax reporting purposes, and ask the representative to print a copy of the name and Social Security number on file. Compare that information to your Social Security card, and if anything does not match exactly, request the correction immediately. Banks are required to update this information within 30 days when you provide proof of the correct information, and the corrected records flow to the IRS automatically through the next reporting cycle. For additional peace of mind, you should also request a free transcript from the Internal Revenue Service showing exactly what income sources reported to them under your Social Security number last year. This transcript is available online through the IRS website at irs.gov by creating an account or requesting the transcript by mail using Form 4506-T. The free transcript shows every Form 1099 the IRS received, including 1099-INT from banks, 1099-DIV from brokerage accounts, 1099-R from retirement accounts, and 1099-SSA from the Social Security Administration. Review this document line by line against your own records, and any discrepancies should prompt an immediate amended return through Form 1040-X before the 3-year statute of limitations closes your window for corrections. This single habit of reviewing your IRS transcript annually catches problems that otherwise grow into expensive tax penalties or lost refund opportunities. As we approach the most important action item of this entire video, I want to remind you to subscribe and turn on notifications if you have not already done so. The information I share in these videos changes constantly as new legislation passes, program rules adjust, and benefit amounts change annually based on cost of living adjustments announced by the Social Security Administration. Subscribing now ensures you never miss a critical update that could affect your specific financial situation, and the notification bell ensures you see new videos within minutes of release rather than discovering them days later when outdated advice may cause confusion. The single most important phone number for any American over 65 to save in your phone right now is 1-800-77-21213. This is the official toll-free number for the Social Security Administration, and the representatives who answer this line can help you verify your benefit amount, request a replacement Social Security card, update your direct deposit information, dispute any bank reporting errors on your Social Security income, and connect you with Medicare services if your question relates to healthcare benefits. Save this number in your contacts right now under Social Security Office because you will not remember it later when you actually need it. You can also reach the Social Security Administration online at ssa.gov, where you can create a free My Social Security account and view your complete earnings history, projected benefit amounts, and any notices the agency has sent you in recent years. This brings me to the critical final point and the most urgent action you can take this week to protect yourself from unwanted IRS attention. Review every bank statement you received during the past calendar year, identify every account that earned interest, and verify that the total interest matches what you plan to report on this year's tax return. If you find discrepancies, gather the supporting documentation now while the records are still easily accessible, and prepare to address the differences before April 15th through either an amended return or proactive disclosure to your tax preparer. The difference between discovering this discrepancy yourself and addressing it calmly is dramatically different from receiving an IRS notice and trying to respond under time pressure with incomplete records. Taking action now protects both your money and your peace of mind. Let me summarize everything we covered today so you walk away with absolute clarity on what to do next. First, banks automatically report every interest payment above $10 to the Internal Revenue Service through Form 1099-INT, and this happens regardless of whether you want the information shared. Second, ensure your tax return matches what every bank reported by reviewing your statements before filing. Third, consider moving long-term savings into a Roth IRA where interest grows tax-free and never appears on 1099-INT forms. Fourth, claim the new $6,000 senior bonus deduction available for tax years 2025 through 2028 by verifying your age on Form 1040. Fifth, verify your bank has your correct Social Security number and legal name on file to prevent automatic mismatches. Sixth, save the Social Security Administration phone number 1-800-772-1213 in your contacts immediately. And finally, request your free IRS transcript annually through the website or by mail to identify any discrepancies before they grow into expensive problems. If you implemented even 3 of these 7 actions, you could save thousands of dollars in taxes this year alone while protecting yourself from IRS penalties that catch so many retirees by surprise. The bank reporting system is not your enemy when you understand how it works. The system is simply collecting information the government requires by law, and your job is to ensure that information matches your records so no questions arise. Take 20 minutes this week to review your bank statements, verify the information, and make any necessary corrections before April 15th arrives. Your retirement years should be filled with confidence and financial security, not anxiety about paperwork you did not understand until now. You have the knowledge. Now take the action.